Today, we're diving into something truly exciting. 6 stocks that are about to explode, and trust me, you don't want to miss this. But first, let me introduce to you the real brains behind our research. My adopted golden retriever, Winston. He's got a nose for sniffing out the best stocks. So if you thought this was financial advice, well, it's golden retriever advice. Now, before we get into the details, our teaching portfolio this year is up 50%. We did over 100% the last 2 years as well. Not promising particular returns, but I'm promising to teach you for 3 days this week in about 1 hour daily masterclass session, exactly how we do it. If you want to get some of the last seats available, they're completely free of charge. Head over to the first link in the description down below at felixfriends.org/masterclass. So we got big news here. The Federal Reserve is about to cut interest rates. The miserable period of higher interest rates are almost over. It wasn't actually that bad for the market, was it? But it's still a drag, especially if you were in growth stocks. And the market is now pricing in an 85% probability of a September rate cut. And that spells RALLY for certain stocks. Lower interest rates can be a game changer, and today we're going to explore 6 stocks that are set to benefit the most. Let's dive in. First up, we have SoFi, a fintech powerhouse slash kind of digital bank, personal finance, loan, credit card, back end to other fintech companies, and everything rolls into one with a rather impressive management. Now, what does it mean for them? Well, lower rates mean cheaper loans. It means more customers want to refinance their existing loans, and therefore SoFi can attract more business and drive more revenue in. Plus, and I get into that in a moment, their valuations move up with lower interest rates. I'll explain that sort of towards the end of this video. But let's have a quick glance at the actual stock chart here. And what do you see? Well, you see that we have somewhat rallied up here a little bit. I know it's only a baby rally right now, but it is improving. And you can see the background of my chart here going green. What does that mean? Well, it means exactly what it says on the tin. It means it's a good thing. And that indicator is called a trend indicator. It's something that I've literally built over the last 20 years, and we're about to launch an upgraded AI version, which is insanely accurate. Of course, every indicator is just an indicator, and you got to have your risk management and so on, and come and join me for that, and I'll teach you that this week for free as well. But generally speaking, we are expecting SoFi, I am expecting SoFi to recover into the $10 range, because that's kind of where it should be. That's where it was at the end of the year. Why were we there at the end of the year? Because in December last year, everybody thought rates were going to come down like 4 to 6 times this year. And then, well, reality kicked in. So we should be going back to these levels, and those levels would point us squarely back to about $10. So I'm liking my odds on this particular setup. But to understand SoFi, you need to understand where they're coming from. They started with a student loan refinancing business. That got sort of shut down by the socialists in Washington, and they therefore expanded into personal loans, into mortgages, and other investment products, the credit card apps, and trading, and IPOs, and everything else. And this all-in-one app that they have makes it very, very convenient for users to manage their finances, and it allows them to cross-sell. But they do that very, very well. So you come in with your student loan, and you walk out with a credit card and a mortgage and a bunch of other things you didn't know you wanted, and they do that very, very well. In fact, they've also launched an AI sales app is inside it, which will recommend essentially 3 things to you depending on your circumstances, everything that they know about you, but it's essentially 3 sales pitches, which is very, very well done. Now, the next stock we have is Palantir. And Palantir is a massive data analytics AI company, both for government and commercial sectors. As interest rates drop, companies are more likely to want to finance and invest in rejigging their whole compute systems. And I think that'll be good for Palantir. Same time, Palantir will also benefit from the higher valuations that lower interest rates bring that I promise to explain to you in a moment. And I think it's a solid bet. I think it's a very solid company. They're a bit unusual because they are selling their commercial company product at the moment by giving it away. So they basically say to you, come and have some of the the source, and you will like it so much we'll not be able to buy anything else and you come back to us. What does that mean, though? It means that their revenue numbers are not exactly exploding, but everybody's kind of trying it, and the belief is therefore that everybody will come back to it and buy it eventually, and they'll eventually make a load of money from it. That's the pitch. Now, if you look at the stock chart here, we've got that lovely blue uptrend already, so we're doing quite nicely. And if you zoom out a little bit, you see we are at basically a 2-year high here. So you could be thinking, or forgiven for thinking, wow, it's an all-time high, it can't go any higher, why would you want to buy something that's so expensive already? You know, that kind of thing. I only want to buy bargains. Well, I'm a trader, but I'm also an investor. And I don't set up trades on things that are massively falling. Unless I have some real insights into the fundamentals. So generally speaking, a trend that's going up like this is actually a pretty good thing. I think there is reason to believe it could go significantly higher. It does, of course, depend on the whole AI party to keep rolling. But let me walk you through this, and this is going to be unpopular with 50% of American viewers. Trump's going to win the presidential election. Right? Trump is therefore going to put more money into defense. Trump is going to put more money into technology and into stuff that actually works and infrastructure, because that's kind of his businessman approach to life. You may like him or loathe him, don't really care. I have no political opinions on the US, really. I'm just looking at it from a financial point of view. He's also going to cut taxes. He's going to be good for the stock market because he's a rich guy. He wants to do stuff that's good for himself. I know everybody is completely selfless in Washington. I'm sure Trump is too, but you get the idea. So I actually think this is going to be very, very good for stocks like Palantir and everybody else in that sort of industrial military complex that we've got going on there. Now, let's move on to a stock that will make some people shudder. ARK, the flagship ETF from ARK Invest. Now, Kathy Wood's innovation-focused fund is packed with disruptive companies. That's sometimes hard to understand. And I actually think they're going to see some massive growth here. Lower interest rates reduces the cost of capital. It makes it easier for these high growth companies to expand. And ARK is kind of like all over this whole sector. Now, Kathy is a controversial figure in the investment world, and I'm no admirer, but I judge the lady on the whole market cycle. So wait until rates are down and then see how she's done. People judged her when we were in the boom era of the post-COVID era and said, she's better than Buffett, amazing, the old guys lost it, right? And then 12 months later, everyone's like, she's lost it and Buffett's amazing. You've got to look at people over the cycle. Disruptive companies, growth companies, do very, very poorly with high interest rates, and they do very, very well with low interest rates. So right now is kind of their winter of discontent, and hopefully that's going to turn around. Now, our portfolio includes companies in genomics, AI, robotics, and more, and these sectors are likely to benefit the most from falling interest rates. Let's have a look at the stock chart. So here is ARK, and even on a recent glance, you can see, we were in the 52s, we were way higher, 54s up here, and right now we're sort of dumping around down here. And the way I look at that is as follows. Look at these lows, and you're starting to see there is some support zone down here, and that sits around about or just below $43. And that's been going on for a while. Now, right now we're trading here, which means we've broken through the resistance zones from the previous highs, which is rather nice. So we're rather on a tear. So actually the thing has turned rather bullish. And why is that? Because we're now expecting rates to come down. And you see our little green indicator here in the background? That's turned really rather green, hasn't it? And it's been doing that since, well, about $44. If you'd entered 44, we're right now at 47.70. You'd be sending me sweet messages every morning, wouldn't you, about how wonderful my indicator is? And some of you are doing that. So I like it for this. I don't understand a lot of the companies in there. I don't own any ARK, but if you just want to have a pure innovation tech play that's been hammered by high interest rates, ARK is a fairly good bet. Next on our list is a stock or ETF that again makes a lot of people shudder. KRE, the regional banking ETF. You're like, oh my God, that toxic nonsense. So what's the problem with KRE? Well, the problem with KRE is that it's full of a bunch of banks that are run by completely incompetent idiots. Is run by America's finest bank managers. And well, regional banks will benefit significantly from lower interest rates because it boosts the value of what they own. And those guys own a lot of US treasuries, government bonds. And they bought those government bonds when interest rates were like zero. When interest rates go up 5% and you own a 10-year government bond, that bond is now not worth what you paid for it, but it's worth about half of what you pay for it because nobody wants something with a 0% interest rate. And why would you? You can get 5% from the bank, right? So that's the problem with regional banks, and that's why they're basically all bankrupt. But the government has bailed them out because we live in a free capitalist society, except for bankers, because bankers deserve protecting. We should wrap them all in cotton wool. They're really special, precious people. I know, I used to be one of those. We deserve bailouts. How else would we afford our, third and fourth homes and all the sports cars and the helicopters, right? Makes sense, doesn't it? Tap the little guy and send it to Wall Street. That's basically what's happening. But the savior is, as I say, the Fed. So the Fed has basically said, don't worry about interest rates. We're going to pretend that nothing's ever happened to your bonds, and we'll just wait for rates to come back down, and then everything will be fine. That's literally what they've done. So that's literally what they've done, and therefore these guys are positioned to capitalize very, very nicely simply on getting out of the box that they boxed themselves into. If you look at the stock chart, we have exceeded the previous high, which is quite nice. There's still a little bit of resistance over here in the sort of $53 range, but we're looking good. We've literally gapped up, which is a very, very positive indicator, and we are on a tear. As interest rates come down more, these guys are going to be like, we made it and we kept all of our bonuses, and they don't know about all the extra money we paid ourselves, right? Yeah. So we move on from beloved banks to companies that actually deserve to go up, which is what? Well, small caps. You can look at the iShares Russell 2000. Now, I particularly like the Russell 2000 Growth ETF, ticker symbol IWO. And this ETF focuses on small cap growth stocks, which tend to outperform in a low interest environment. And these companies can access cheaper capital to fuel their growth, and they could therefore make IWO a great pick for a little bit more of an aggressive investor. So small cap stocks are often overlooked by larger investors. One reason is that if you've got a $100 billion fund, you simply can't invest in a $2 billion stock or a 500 million stock. You just can't, because if you allocate 1% to it, then you bought the whole thing, right? So it's not worth it for them. Like a Buffett can't invest in small caps. It makes no sense. But for that very reason, they can also offer very significant upside for smaller investors. Now, they're typically in the early stages of their growth cycle, so they have plenty of room to expand. They grow faster than large companies, and with lower interest rates, they can secure financing at more favorable terms, allowing them to invest in new projects and scale their operations finally. If you look at the stock chart, what do you see? Well, you see a glorious thing, and since we first started talking about this here, you see one gap, you see two gaps, and we are just flying, off to a flying start. I would expect that to continue, to be honest with you. Yeah, there might be a little bit of bump, and then we might go higher. But once the first rate cut comes in, and we're now expecting multiple ones to follow, I think these kind of small cap stocks will finally see the light of day again. And finally, let's discuss Bitcoin and its related stocks. There are things like MARA or MSTR or SMLR, which all trade largely in line with Bitcoin. And I know to a lot of people, Bitcoin still seems a little bit weird, and therefore they prefer to invest in stocks. So we're going to look at one stock here. As interest rates fall, the opportunity cost of holding non-yielding assets like Bitcoin decreases. And I know there is staking and all of that, but that's gotten a little bit of a bad rep. So more investment is going to be driven into cryptocurrencies, in my view. We also have, in my opinion, the next president of the US, and I know some people are going to hate me say that, who is very, very bullish on Bitcoin. He's going to speak at the largest crypto conference in the world shortly. So the SEC's hatred and persecution of all the kryptonites seems to be coming to an end fairly soon, unless something really weird happens, like Trump forgets his name or something, or, who he's running with, or, any of those things that would make people go, you can't possibly vote for that man. And some people are now thinking, I'm a Republican. I am not. I couldn't really give a hoot. I just care about what's the most likely outcome and how do we make the most money out of it. It's very, very simple. So I'm looking at stocks like Mara and MSTR, which are heavily invested in Bitcoin, and they stand to benefit immensely. And Bitcoin has been gaining mainstream acceptance faster and faster because it's an inflation hedge. And if you look at, as I say, companies like Mara and MicroStrategy, they've made very significant investments in Bitcoin, essentially betting on the long-term potential there. And again, lower interest rates, the cost of borrowing in Bitcoin decreases, making it an attraction option for more people. Now, you might be wondering, why do falling interest rates increase the valuations of these stocks? And I left this till the end because I know it's going to scare some people. But let me explain it with a metaphor. Imagine you have a magic garden that produces golden apples. You may close your eyes. Each golden apple represents the future cash flow a company will generate. To know how much your garden is worth today, you need to consider two things: the number of golden apples it will produce in the future, and the value of each golden apple today. In finance, the value of each golden apple today is determined by the discount rate. Think of the discount rate as a magical spell that affects how much each future golden apple is worth in today's terms. When interest rates are high, the discount rate spell is strong, making each future golden apple worth less today, because you could earn a lot of interest by simply putting your money in the bank instead of waiting for golden apples to grow. But when interest rates fall, the discount rate spell weakens. This means that each future golden apple is now worth more today because you can't earn as much interest by putting your money in the bank. So when interest rates drop, the value of each future golden apple increases. I hope you enjoyed my little golden apple metaphor. Felix has lost the plot. Okay, so in a discounted cash flow model, or DCF for short, we estimate the future cash flow, the golden apples, a company will generate and then discount them back to their present value using the discount rate, the spell. When interest rates fall, the discount rate decreases, making the present value of future cash flows higher. This increases the overall valuation of the company. I think I might have tasted one of the golden apples, so I can no longer speak. So in summary, when interest rates fall, the discount rate spell weakens, making the future cash flow of these companies more valuable today, thereby increasing their valuations. Make sense? I hope so. Now remember, our teaching portfolio is up over 50% so far this year. And if you want to learn how we achieve these results, come and learn my strategy on the 3-day masterclass this week at 8 p.m. Eastern time, where I'll teach you exactly that. felixprehn.org/masterclass. Now remember, I never promise you outcomes. I don't promise you returns because it would be dubious and illegal. I promise to show you what I do and how I do it, and the rest is up to you. The link is down below in the description. Grab yourself a free seat and let's make some money. Today, we're diving into a stock pick that's got Wall Street buzzing. Now, you might be wondering, who's this stock picker that's got everyone talking? Well, strap in, because we're about to embark on a journey through the mind of one of Wall Street's most respected analysts, Tom Lee. But here's the kicker. We're not just going to tell you what